Hi, everyone. In this edition of Kuvera Insights, we speak with Manish Gunawani. He's the head of equities at Bandhan Mutual Fund. Manish is a veteran of the Indian equity markets with more than 25 years of investing experience. He was a CIO equities at Nippon Asset Management and the deputy CIO equities at ICICI Prudential AMC before starting at Bandhan in Jan 23. He's an engineer from IIT and an MBA from IIM Bangalore. Hi, Manish, and thank you so much for taking the time to join us today.
Hi, Neelabh. Thanks for having me.
All right, so jumping right in, Manish, what we are going to try and do is we are going to try and help investors, use some kind of thumb rules or develop some kind of mental models that they can use to invest across while investing across different market cycles or maybe across different economic cycles. So the questions are going to be related to that, and we'll be very grateful for you to share your insights on those along with some examples wherever possible. Right. So we often read about domestic indicators which are used as leading indicators of performance of the equity markets, so to speak. So we wanted to sort of understand, is this really true, and could you help us understand with some examples?
Sure. So there are a lot of these indicators, right? IIP, GDP, credit growth, CV sales, etc. Generally, I found that the very, very broad indicators like IIP and GDP, honestly, have not been able to make too much use of them, especially because they are deflated to make it a real number. But what happens is, because it is deflated, it becomes too complex. We live in a nominal world where, we are measuring sales profits on a nominal basis. So first of all, I prefer to have the more nominal variables rather than the real variables. Two indicators I have found useful for turning points is CV sales and credit growth. So CV sales, for example, I think is a good turning point at the bottoms, because typically a simple rule works there. The simple rule is that because the life of a truck is typically 6-7 years, in severe bottoms like in 2020, you will see that the CV sales will drop to a level which is less than 6-7 years back. So what it effectively means is, see, every year you say sell X number of CVs. So there is a fleet of 6 to 8X on the road. So when the number sold in a particular year is less than 6-7 years back, effectively the fleet is dropping. And India in general is a growing country. So ideally the demand today should be more than 6-7 years back. So if the fleet is dropping, that means it is the bottom of the economy. And I always feel that when you see that kind of number, you should realize that you are sitting at a big bottom. And typically things will look up from there. Unfortunately, I have no metric for the mirror image ki what is the top, because the top can be anything. But at least for the bottom, there is a bit of a rule of thumb which I found works. So similarly, credit growth. Now, credit growth is also a very funny variable. I found that across almost every major economy, credit growth has grown faster than nominal GDP. And if you take India also on a 30-40 year basis, almost true for every year, apart from the period of 2015 to 2020, somehow in that 4-5 year period, if you see that credit growth was more or less equal to nominal GDP or some years less also. So we were between 8 to 11, 12% kind of credit growth. But I think when you are investing in banks or NBFCs, which are typically riding on the back of credit growth, I think it's a safe assumption to make that it will grow faster than nominal GDP. So these two variables I have kind of applied more in practical terms in selecting stocks and kind of getting the turning points. But other indicators I found I am not able to not that much correlate with what is happening in the market or the economy.
Right. Or maybe the lagging or leading in terms of the period is not or there's too much variability in that.
Yeah,
So
they are not very coincident. Like PMI will give you a sense what is happening now, but there is no rule to say that 50 is the bottom or 48 is the bottom or 55 is the bottom kind of thing.
sure. Uh, Thanks, Manish. That's very useful to have your insight on this. Now, another along the same lines. Now, the governments also react to these, some of these indicators, since some of these numbers do come from the bottoms up, right? And uh, sometimes, it will be in anticipation of a recession, or vice versa, that there are some, sort of tightening that the government does on the rates front, or maybe even on the macro front. They are, maybe there's an expansionary stand the government is taking. These are typically, I would assume that these are reactions to what is being anticipated would happen over the next 2 months to probably 6 months, even a year's time, right? uh, so are we, how do we use these as an investor? How do we use these kind of actions, policy actions, in the current time, and what segments of the market would get impacted more to such kind of announcements?
Yeah, that is quite interesting. So typically, if you think about it, the government directly or indirectly controls three big policy levers. One is fiscal, which is the government spending. Two is monetary, and three is the exchange rate. Now, typically, when the economies are in crisis, like Lehman or COVID, we find that especially the fiscal and monetary policy is used very actively. And people who have bought at these bottoms, just looking at the response of the governments, especially in COVID, when globally the response was very, very aggressive, they have gone right because you imagine yourself sitting in March 2020, there was no visibility on earnings because a lot of the industries were shut. But if you just look at what Fed did, what US government did, uh, that can help you as an investor. The interesting part today, I think, where a lot of investors are getting stressed out in one sense, because what is happening today is while monetary policy is trying to get inflation down and is restricted because we are seeing very high interest rates. But if you see globally, the fiscal policy is quite lax. So US is running fiscal deficit of 8-9%. Even India is running 9-10%. So why is this fiscal policy lags? Because there are goals which are not, in one sense, purely economic goals. One is
Right.
climate change, because of which there is a big investment in renewables. There is geopolitics, because of which, for semiconductors and general manufacturing, people want their own country to manufacture rather than import from somewhere else. So these are not truly economic goals. So the fiscal policy is moving in a direction which is at odds with monetary policy, which is why a lot of investors felt that growth would slow down globally this year. That's not happening. A lot of it is because fiscal policy is loose. So I think the investment opportunities today are where the government is incentivizing investment. You obviously have to be nimble and see if the government policy changes, you will have to change your view.
Right. So these are, we are sort of doing this backwards as investors, because once certain numbers would get published in the first to the first question, the CV sales or credit growth. These are numbers of the past. When the government is taking an action, they
Yeah.
are taking an action, maybe using some of those numbers as inputs, right?
Yeah.
Which are on the forward. Now, another practical question that, and while it's very difficult to, sort of predict tops and bottoms in, across markets, and forget short term, even long term tops and bottoms are impossible to predict. But it's useful to have an understanding of how do risk rewards move across market segments. In terms of market cap, how does risk reward move across let's say bull tops and market bear bottoms? How do risk rewards move? And from an investor's perspective, how should they think about these segments?
See, one thing is true that whenever there is a unknown shock, which is either a liquidity shock like Lehman or a COVID shock, which is an economic shock, there will always be more damage to the less liquid space, which is the small and mid cap space versus the large cap space. But I think there are two big differences which are gradually happening. One is that for a fair amount of time, the foreign investor, the FII investor, was the dominant driver of Indian markets. And whenever there was a global risk off let's say 2015 or 2017, the impact was magnified because they were the primary drivers. Today, I think as the domestic mutual fund industry has scaled up and domestic PMS AIF industry is also scaled up to a certain extent, we are seeing a bit of balance across multiple drivers of the market. So I think one is that maybe the sensitivity to a global risk off today is much, much less than, let's say, 5 years or 10 years back. The second is, if I look at the current environment, I think while globally growth is slow, we are in a bit of a strange environment that, see, historically for last 20-25 years, what has happened is whenever we've seen periods of global recessions, the dollar has appreciated, and dollar appreciating typically is a big drag on liquidity. I think what will be interesting to see is that given that dollar is very expensive, has done well for last 10-12 years, even in a global recessionary or a global slowdown, we may see that the dollar may weaken, in which case, again, the chance of a big drawdown in mid and small cap goes down, because if the dollar is weak, then the liquidity tightness is not as high as it used to be. So I think structurally we've moved to a more stable market. But of course, if unknown event like COVID happens, then obviously we will see damage to mid and small caps.
Right. So while that's fairly, comprehensive, it's hard to again, and your insight would be helpful, but it's hard to sort of use these indicators as a prescriptive action. Maybe you can take a call on direction, but what remains a variable is time. Which is, sort of the next question also. What role does an investor's investment horizon play? And also, to bring in the concept of asset allocation. And if you can just sort of, in the light of the previous three questions, how does one use asset allocation and my investment horizon? How important or not important does it make some of these variabilities which I may be able to observe by virtue of access to media and information, but I may not be able to interpret and act on, or even if I have the capability to act on, I may not be taking the correct decision. So as an investor, what role does an investment horizon play, and what how do you use asset allocation to make a personal investing decision?
So first of all, I should be clear, whatever we discussed in terms of macro forecasting, whether CV sales or dollar or whatever, I think asset allocation is 100 times more important in all this, because macro forecasting is always fraught with error, right?
Yeah.
A lot of things can change. No one told us Ukraine war will happen or COVID will happen. So first of all, I think irrespective of your view on mid cap versus large cap on economy or whatever, the fundamental basis of financial health and freedom is to have good asset allocation. Now, obviously, asset allocation first of all starts with the objectives. So I can talk personally, let's say, right? When I started my career, to be honest, because we were working in Bombay, uh, our allocation to equities initially was very, very low, because initially, after a few years of working, when you buy a house in Bombay, it tends to become a very big part of your net worth. And the first focus is obviously to retire the home loan as fast as possible. But then as you go along, I think over investing in real estate is probably, for my generation, the biggest mistake they've done. Because the earlier generation made a lot of money in real estate, I think. And there is an Indian family tendency to extrapolate that past to the future. But last 10, 15 years has not been great for real estate, right? So luckily for us, at least, we have not bought real estate beyond where we have lived. And as we progressed in our career, I've invested largely in equity. Honestly, I don't have too much of fixed income. One of the reasons I don't have fixed income is partially because the PF in a way becomes your fixed income part.
Yeah.
Wherever I have felt cautious in markets, I have used balanced advantage fund just to reduce the risk, but not used fixed income too much. So that's been my journey, that start with something safe like real estate where you're living. And then as you build the risk assets, as your balance sheet becomes better and better, could I have leveraged at some point? Yeah, some people I know have leveraged and made money in equities more than I have. That's obviously a very subjective call people will have to take. Also, coming back to your question on time frame, yes. I mean, I wouldn't invest in equities if I have less than 1 or 2 years, because you don't want to sell equities by force, right? Because you might be selling when the market is bad. So I typically don't invest in a mutual fund unless I have perfect clarity that at least 2, 3 years I don't need that much of money. And internally also, I think that 3 years is a good time frame to my mind. See, beyond 3 to 5 years, it's very difficult to predict macro or what the world will look like. So I think you should take a call on allocating to equities with a 3 year perspective.
Right. Well, I think that's a very interesting way, and I'll just probably paraphrase you a little bit, is that what you invest in equities, you should be prepared to hold it and sell it when you actually don't need to sell it. I mean, only if you
yeah. That's a good way of putting it. Yeah.
So rather than sort of it's like real estate, right? If you have to sell it, the time when you have to sell it, it will be the time when you need to sell it. It's where real estate becomes illiquid. It's hard to find buyers. Market goes into slump, and that's what we've seen for, at least for real estate. But from a market's perspective, because equities does require a longer term horizon, you should be, if you have a requirement, if you are an existing investor, if you have a long-term investment horizon, but you have a requirement over the next 3 years, let's say, then either you should sort of follow a glide path towards de-risking your portfolio so that you have asset more focused towards debt to meet that 3-year investment horizon requirement or 3-year funds requirement. But longer than that, you can definitely think about equities. Main thing being that you have the freedom to make that choice, not be forced to make that choice.
Yeah, you should always invest in equities with a peaceful mind. You should never invest when you feel okay, in 6 months I may need this many or something like that.
No, absolutely, very a very valid point. Uh, Now, so we are actually at the end of the discussion, and I just had one question which is specific to Bandhan Mutual Fund. And how does an equity fund manager, and you're the big boss here, so how does an equity fund manager at Bandhan MF manage all of the above risks, especially when you're investing in a scheme where in various schemes where multiple investors with different appetites, different investment horizons, different kind of risk appetites participate. So how do what is the risk management philosophy and what is the risk management process that is followed?
I think that's very important. See, what happens is there are so many questions in our business, and unless we ask the right questions, our right answers are not likely, right? So the point is, I think each fund manager and analyst in our team, they deserve to know what is the boundary of our fund, what is the time frame with which we are measuring. So we've been perfectly clear internally that our sweet spot is 3 to 5 years. So both fund managers and analysts, we measure on a blend of 3 to 5 year kind of time frame. Also, for all our funds, we have a comprehensive risk management framework called the fund casing, where what we're trying to do is to say that if you visualize 100 units of alpha you want to create, I think 80 should come from stock selection and only 20 should come from either a macro overlay or a sector overlay, right? Because what we've seen is if you see 2017 to 19, a certain type of stocks worked. 20 to 23, something else has worked. And we never know what will work going forward. So I think if you want to create granular and consistent alpha, you need to define these boundaries to your team. You need to define the time frame for which you're investing. And then this is a necessary but not sufficient thing. Even after all this, we may not create alpha, but I'm sure that if you don't do this, whatever alpha you're creating is just luck. So we obviously don't want to do it by luck. So we have a fairly comprehensive fund management risk system called fund casing. Our research team has been told that 3 years is the sweet spot, and we are all focused on that time frame. So yeah, I think it's very important to define what you're trying to deliver.
Right. I think what I took away, one of the things at least that I took away, that the process has to be very robust and well defined, and sort of fund manager discretion or thought process has to play within those boundaries of risk.
Yeah.
Because the fundamental difference as a fund manager is you are a fund manager. So
Yeah.
you are you are managing opium or other people's money.
Yeah.
So no, so that's great, Manish, and thank you so much for your insights. We are at the end of our discussion here. If should we have any further questions or if we have any follow-ups from our discussion today, we will reach out to you. And thanks once again.
Thanks a lot.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.